Hey, everybody. Thank you for joining us for today's episode of Certainty Talks. On this show, we talk about the system that we use to get clarity on our goals, certainty that we have the tools to reach them, and wealthy on our terms by rigging the game in our favor. And we share it here because we want to help people like you reach your goals on your terms. You've been told to scale, buy this product, buy that product, often from well-meaning people. And so it's not your fault when you look around and you ask yourself, why am I not where I want to be in my business? And as our mentor and business partner, Dan Nicholson, says, the biggest risk we take is not getting what we want out of life. Got my good friend, business partner here, Mr. Paul Sparks himself, not only a successful real estate investor, but also a certified certainty advisor. And guys, if you get value out of the show, please hit that subscribe button right now. That way we can help more people become wealthy on their terms. Title for today's show is Brain Melting Math 2.0. But before we get into that, Paul, what do you got for a 6-word update?
6-word update. All I do is give presentations. It's funny how how things have changed since a year ago when you and I started. I was a little over a year ago when you and I started doing this, but it's like that's all I do now. I had two presentations a week for Whale Club. We've got 2 podcasts that we do every week. We did a 3-part webinar series this week and last week, and I've got the Whale Club event tomorrow. So it's just funny as I'm reflecting on, it's like, what do you do all day? It's like pretty much just all I do is give presentations.
You'd be careful. You might turn into an influencer.
Yeah, might do it. But that's what I like to do. I like to think about things, to give presentations on things. And so it's cool. This stuff works. And I'm starting to play my game a little bit.
All right, wonderful. So for me, my 6-word update, boring realtor play with upside. So I finally got the website up and running, posted on Facebook this week. Got really good engagement on it, so that's a positive sign. So we'll see where it goes. But, that talk that you and I had months ago, we're finally now collecting a wait list.
That's great. Yeah. How's that going? How's the wait list going?
I think we got 4, not great, but I have it set up. We talk about certainty and making sure you microstep the right way. So I have it in the thing. Like, you have to let us know how you heard about us, right? Because it benefits the partners. But indirectly, what I also know is who's not carrying their weight. So now I'm gonna go back and say, hey, I've noticed you're not getting a lot of engagement from your audience. What's going on? Are you promoting it? So an indirect benefit of attribution is we can see who's not carrying their weight.
There you go. Benefits of microstepping.
And yeah, like before, I'd be like, hey, we're doing this event on this date. I don't care how many people come. Now it's going to be like, we're not doing this event until 50 people raise their hands. We're just not going to do it, right? It's not worth my time if there's not enough interest. And it's not, and instead of spending all our resources, our time, our effort, our energy, squandering all of that, burning our people out, spending money on events, we're not doing any of that until we know that the market demands it.
That's good stuff, man.
Yeah. We're learning, applying what we're learning on Certainty Talks and the Whale Club. All right.
Isn't it funny how long it takes too, right? It took a while for us to get here.
And we're still violating it.
I know, constantly.
Still violating it. I personally cost us money a couple of weeks ago. Not microstepping, not collecting, making a decision. It's like, damn it, I'm still violating this. So, but it's an iteration, and we're getting better. All right. So, what's the problem? Why do we need brain melting math, Paul?
Well, if you guys watched our brain melting math that we did, I don't know, this was probably a couple months ago, maybe more. This is brain melting math 2.0. And the real problem here is, really before I understood this, my default was to just more. And because we don't understand the math that I'm about to show you guys today, and Dan showed me this, and it was like my brain melted right then and there. It was like cracking an egg on a car in Phoenix in the middle of the summer. It's like just melted, and it was staring me right in the face. Like I was fighting harder um for more without really understanding the levers and the buttons and the knobs and all the things that you can pull to get closer without actually doing any more work, without doing any more effort. A lot of times we fight so harder because so much harder to do more because it's just easier to do that. It's much harder to slow down and take a second. So
Well,
we're
and
going to show you guys some math today.
I think there's a reason for that, though, right? I mean, like, um, the people that are attracted to what we do, right? Real estate generally tend to, the ones that have any kind of success tend to embrace the willingness to do what it takes, right? That mindset. And so our orientation in our group, our audience tends to be let's do more. And if I'm not getting the result I want, push harder. If I'm not getting the result I want, push harder. Right? And that's the tool that's worked for us for so long.
Mhm.
So it makes sense why they're that way.
Yeah. Well, and I do think that a lot of us, for whatever reason, we see a path to financial freedom and certainty as we want to build this big business.
Hmm.
And, you know, I'm not suggesting you shouldn't build a big business. All I'm suggesting is you may not need to build a big business in order to get what you want. Big businesses come with big problems, all sorts of big things, right? It's not always rainbows and butterflies. And I would rather optimize my business for like the smallest and the most reliable it needs to be to still fund the things that I want in life. I'm not trying to endlessly grow a massive business. The business is sort of a means to an end, right? It's allow me to pursue what I want in business, pursue what I want in life on my terms. And so, we'll just show you a little bit of math today about how it's easier to just take the time to understand this to get closer without actually chasing more and more.
Perfect.
So, uh, we have a phrase that we talk about, and we talk about it on this show, but we talk about it in Will Club quite a bit. It's we call the three C's, and we borrowed this from Dr. Jeff and Nick. Again, everything we do comes from somebody else, right? We haven't had an original thought in a while. We're just learning this stuff from these people and applying it in our life. But they call the three C's clarity, certainty, collapse time. And when we talk about clarity, we're talking about the solvable problem. You know, what are you actually trying to accomplish in your life and your business? What do you want? And it's a very simple question, not easy to answer all the time. What do you want? It can almost be anxiety inducing. And so we spend a lot of time on this show talking about how to get clarity on the solvable problem. Because if we don't know where we're going, how do we know we're getting closer to it? It's sort of like the Cheshire Cat in Alice in Wonderland. You know,
Yeah.
if she says, "Hey, which way should I go?" And he says, "I don't know. Where are you going?" It's like, well, it doesn't matter. It doesn't matter which way you go if you don't know where you're going.
Right.
And that's part of clarity, right? We've got to get clarity.
Absolutely. And it's actually kind of funny. My personal trainer, she was asking me some questions, and I was giving her the, I don't know, what do you want? And she didn't have that answer. I was like, well, then you need to read Rigging the Game. And so
Mhm.
on Tuesday, she shared with me she finally finished the book. She's like, this should have been required reading in high school. I was like, not a bad idea.
Yeah.
So anyway, that's clarity.
Well, let's say, for example, that and I'm going to use big numbers here because I don't want to play a small game. I want to play a big game. Let's talk about the scenario where you get it all. Like you get everything that you want out of life.
Hmm.
And let me just throw out a number. Let's say it's $10 million. You go through our solvable problem process, or maybe you're working with a coach that you have, or maybe you're reading one of the dozens of books out there, hundreds of books out there that talk about goal setting and things like this. Um, we like to think we have a pretty good process to go about this. In fact, I know we do because it's been massively helpful for you and I. And we're really going to be digging into that actually tomorrow at our Whale Club event. Is just how do we get clarity on what do we want? What
Hmm.
is it that we actually want out of life? Um, but let's just say we were able to put a number to that, and it was 10 million bucks, right? $10 million. Most of us is like, wow, if I had $10 million, yeah, I could pretty much do what I wanted when I wanted on my terms, on my timeline. Of course, assuming you're not dummy and you squander it all away or something like that. But, you
Right.
know, I think let's use 10 million as an example. So you got clarity. 10 million is the number. It allows me to fund the things I want on my terms and my timeline. Then we implement certainty, which is what we talk about a lot on this show as well. It's all about, which is the second C. So clarity, certainty. And certainty is all about how do we actually navigate the terrain of life? How do we make decisions that help us get closer to that goal and optimize for it?
Mm-hmm.
Um, and really, what I want to do today is I want to spend time on the third C, which is what we call collapse time. It's essentially okay, if we know where we are and we know where we're going, we think of it as almost like a Google Maps. When you plug that into Google Maps, it's going to give you the most efficient route to get from where you are to where you're going. It's not, yeah, there's a million ways you could go.
Mm-hmm.
You could turn around and go all the way around and whatever. Point being, Google Maps is optimizing for the least amount of time and the least amount of risk, I suppose. They're going to
Mm-hmm.
put you on highways. And so when I think of collapse time and what we're going to talk about today with the brain melting math is how to do that. If you know where you're starting and you know where you're going, let's look at some numbers so that we avoid chasing more and more and more and we optimize for like what we actually need to hit our goals.
Gotcha.
So I'm going to switch over to a spreadsheet here. Now, this is going to be a little difficult if you're listening to this. So I highly suggest, if you can, to go over to YouTube. So Steve and I actually migrated our uh, Certainty Talks podcast. Long story short, it was throwing off the algorithm a little bit.
Yeah.
Yeah, so we moved it to its own YouTube channel. So you guys might be wondering where to find Certainty Talks. And if you're watching or listening to this, you're going to want to try to go over to YouTube. You can search for Paul Sparks Official. That's my YouTube channel. Under that, there's a Certainty Talks playlist. We're going to put all the Certainty Talks stuff there. In fact, if you like certainty for real estate, definitely go subscribe to that because we're going to be pumping out a lot of content related to how to use these tools. So if you want to follow along and watch what I'm doing, it's going to make it a lot easier. But of course, we're going to try to talk through this so that if you're listening, you can still get the majority of it. All right. So let's talk about a scenario again where we're going to talk about the least amount of risk, least amount of effort, and most amount of options to get to $10 million. That's the goal here today. Now, I'm going to use, again, some fairly large numbers. Now, not everyone's going to be starting out with what Steve, can you see this? Just
Yeah.
making
Half a mil.
sure.
Yeah.
Great. So you got $500,000. And I'm not necessarily talking about $500,000 sitting in cash. I'm talking about maybe you've got it inside of, and again, let me just preface all this by saying none of this is financial advice. This is just math that I'm trying to show here today, right? Not advocating you do or don't do anything. I'm just suggesting this is something that could be done. All right. With that being said, let's say you got $500,000 in a HELOC or in an IBC policy. Now, right now, the rates for a HELOC are a little higher. They're probably closer to like, I don't know, prime plus one.
Yeah.
But there's a lot of places historically where you could borrow against equity or against an asset that you've already got. And let's say you could borrow against that at 5%. Again, maybe it's in an investment account. It could be cash, and this could be zero. This number right here could be zero, not 5%. And I'll talk about a couple scenarios here. But let's say you're starting with that. And you take that $500,000 that you've pulled out of your HELOC and you turn around and you invest it with a private, as a private lender, let's say. Now, there's people all over the country who will give you 12% for fix and flip loans, for development projects, for all sorts of stuff. You can go out and you can buy long-term rentals and get 12% return. You could do this with short-term rentals. There's syndications. I mean, there's tons of opportunities to be a fairly passive investor and earn about 12%. Would you agree with that, Steve?
Wholeheartedly. It's a skill that can be learned, acquired, and be really simple. If you have capital, you could find someone that will pay you 12. It wouldn't be that hard.
Yeah. And the big part of this 12% right here is relationships, right? Investing in the person. In most cases, you're investing in the person when you're doing private lending.
Yeah.
When you're doing long-term rentals, you're investing in the asset. Short-term rentals, it's usually the asset. Syndications, it's probably the person. Again, if you're watching this, you can see I've got some of this stuff kind of listed out here. All right. So if I take my, back this out a little bit, it's easier to see. So if I take my 500,000 and I borrowed at 5% and I invested at 12%, well, that's a net monthly income of, about $3,000. It's 35,000 a year.
Yeah.
And that's pretty obvious, right?
Mm-hmm.
7%. It's 12 minus 5. Makes sense. You're like,
Yeah.
okay, I get it. What's the point? Who cares? Well, here's the thing. As you're investing this from the HELOC, and again, I'm just using the HELOC as an example, and you're making that arbitrage between the 7%. What I'm advocating for here is, let's say you do this, and at the end of year 1, you pay off your HELOC. You pay this back off. So we're not continuing to, reinvest this money. We're just going to earn this 12%. Thank you. And we're going to pay this one off right here. And we're going to keep the difference.
Mm-hmm.
So what we're really doing here is we're creating a surplus. I like to call this house money, right? We got paid. We paid off our original debt. And now you've got a surplus. Great. So you say, what's the point? All right. Now, a lot of us are active investors. We're listening to this, episode right now, and you're not a passive investor. You're like, I want to wholesale. I want to flip. I want to do developments. I want to do value add multifamily or self-storage or whatever it may be. Because maybe it's because you want to leave your job. But what I can tell you is my experience is most of the people who actively invest are earning, let's say, something like 70% on their money. So let me give an example, Steve, and you tell me if I'm off with this, and maybe we can lower this to 50% to just make it a little bit more practical. So if you earn $35,000 from taking your money from your HELOC, you invest it with a private lender, they pay you 12% on 500 grand, you pay off the HELOC and you keep the difference, and that's 35,000. So great, you got $35,000 of house money. Now, if you go out and do a fix and flip with 35,000 and you're putting 10% down on a fix and flip, so that's a $350,000 home, and let's say you sell it for $450,000 and you make 35 grand. I mean, in this case, I'm showing 50%. So that's like making what? 17 grand ish.
Yeah.
So what I'm suggesting is, let's say you do a flip with $35,000 and you make $17,000, and that's it. Once. I'm talking once in the entire year. So your whole first year, you're doing nothing except for finding an operator to place 12% with. The second year, you're taking that $35,000 and you're flipping it once, and you're earning 50%. I think it's a little bit more reasonable to earn 70% on a flip. That's what I'm seeing. Yeah. Right. So let's use 70% here. And so throughout the entire first year, that's all you do. You do one flip. So at the end of your second year, so the first year you made 35,000. Great. The second year, you took that 35,000 and you invested it to get an extra 70%. So that comes out to about 60 grand. But you also have the 35,000 coming in from the second year. So you're going to do this twice. You're going to draw money from your HELOC. You're going to invest it with an operator. At the end of the first year, you say, thank you, I'm going to take my chips off the table. And then you're going to make another loan back to them again. So you've done this now twice. At the end of the second year, you're left with $94,500, which is $35,000 plus about 60. Yeah. Following so far? Yep. Pretty straightforward. Now, what happens if you take this $94,000 off the table? Again, you took it off the table from your private lender. You took it off the table from your flip. Now, also, I realize that I'm not accounting for taxes here. this is not a debate on tax strategies, right? I'm just trying
Right.
to show some math here. So you've got 94,000, you pay off again this loan here. So your principal is protected. And of course we want to do this because let's say, for example, you're borrowing $500,000 against your house, your primary house. I mean, we don't really want to take a lot of risk with that,
Mm-hmm.
right? So we want to pay this off as quickly as we can. Now, let's say we took this 94,000 and all we did for the next 8 years is flip that money every year at 70%. So we take this and we invest it to get 70% return year over year for the next 8 years. That's $6.5 million by the end of the total 10 years you've done this. You're now sitting on 6.5 million. You're like, dang,
Yeah. I mean, 6.5 million is pretty good.
that's pretty good, right?
Yeah. Starting with half a
Um,
mil in equity.
and so we need this to get to 10 million, right?
Mm-hmm.
So you say, okay, well, of course, if your number was 6.5 million, you're there. Just do that. But what if you did this year after year after year? Again, remember, I advocated with this 94,000 number. That's like just put your principal at risk for 2 years. Put it in the hands of a private lender 2 years in a row, take the earnings off the table and funnel it into flip projects. If you just exposed your principal for 2 years, you'd have $94,000 at the end of those 2 years, and if you took that money and invested into flips, you'd have 6.5 million by the end of 10.
Right.
But if you did that same process every single year of take the 500,000, put it into a private investor at 12%, take the chips off the table, the next year you're just taking that money and putting it into a flip. Do that every single year for 10 years and you're at 10 million.
It's pretty simple.
So what does this say? Here's a couple things I want people to think about. So this is one scenario.
And
To
just
get
keep
to
in
10
mind
million.
when we're talking about this whole deal, this is just one flip a year.
Well, so I say a flip, right? So let's look at this as it breaks down. Year one, you make 35,000 from your private lender. You invest that into the second year and you do one flip with the 35,000. That becomes about 60 grand.
Mm-hmm.
Then the next year, you still got 35 grand coming in from the private lender, right?
Mm-hmm.
Plus, you're investing this money again.
Right.
And so it continues to grow, right? And so, of course, if you're on year, 9 here, you're at 2.4 million, you'd have to figure out how to flip 2.4 million into 4.15 million. Now, of course, as you continue to grow as an investor, you might do one flip and then another one flip and then another one flip. By the end of year 3, you're doing 2 flips.
Yeah.
Then you're doing 3 flips. Then you get to $500,000 and you're like, maybe we put this into a value add multifamily. And you get here. And then this year, you're like, let's throw this into a development project. And you get here. So you start to see like it doesn't need to come all at once. It can start by, and I can tell you right now, I'm doing development projects that are returning like almost this amount right here, 2.4 million in profit on one deal.
Yeah.
So as you continue to grow as an investor, you may graduate from doing one flip a year to one flip a year to one flip a year. Now you do 2 flips a year. And then now you do one, value add multifamily deal. And then you do one development deal. And my point is,
Yeah.
it doesn't necessarily have to be more deals. You can do it by just making one fantastic investment every single year. And guess what? You're playing with house money.
Right.
This is all surplus that we're multiplying.
Can you,
Because
for those that are watching this, can you elaborate on FV? Because the way you have it written is different than how I would write it. So can you just elaborate what FV is?
Sure, this is a future value calculation.
Mm-hmm.
So future value is like, what's the value of this in year 10? And in fact, this should be reversed. So yeah, this should say future value year 10. I've just got these backwards.
Okay.
Basically. But that's how future value is calculated, it's like a negative,
Mm-hmm.
if that makes sense. So
Yeah.
don't ask me to explain the math. I just know how to plug it into the equation here,
Okay. Perfect.
right? And so point is, you could take your chips off the table and just flip with just house money
Mm-hmm.
with no risk to your principal and end up with 6.5 million. Or you could continue making this bet with 500,000 into a private lender every single year and just arbitraging the difference. Borrow it at 5, invest it at 12. Borrow it at 5, invest it at 12. You do that for 10 years, you're at 10 million. Now, let me give an example of what I see a lot of people say. They're like, well, why wouldn't I just go the other direction? Why wouldn't I start flipping first? Well, let's look what the math says. So you invest $500,000, you borrow it at 5%. Of course, I'm not suggesting you do that because if this is a HELOC on a primary residence or you're borrowing against some sort of investment account, this is the goose, man. We don't want to we want to keep the golden goose healthy
Right.
and protected. So I'm just suggesting this is the way I thought. Was like, well, why wouldn't I just go get a bigger return? We'll invest the 500 at 70%. Now I'm making 325K a year.
Mm-hmm.
And I'll take that 325 and I'll pop it in here and earn 12%. Again, let's look what the math says. At the end of year 10, doing it just taking the money off the table, right? At the end of year 2, you invest into a fix and flip at 70%. You do this 2 years in a row. You flip, take the money off the table, pay off the HELOC. Flip, take the money off the table, pay the HELOC. And then you're just investing this sum, 689,000 at 12% for the next 8 years. You're at 1.7 million. And when you do this over and over and over again, the same way we were talking about before, you're actually only at 5.7 million. That math blew my mind when I saw that. Because what most of us will do is we'll take on more risk than we need to.
Mm-hmm.
We're taking on high risk here with our principal at 500 grand, borrowing it at 5%, and we're saying, I want more. This number's bigger than 12. So
Right.
I want 70.
But
But
why wouldn't
instead,
you do the 70% on the 325?
so you would invest it back into fix and flips is what you're saying.
Yeah.
93 million.
Yeah. So you're saying the order. So if we were to do the money and then put the profit into the lending.
Yeah. So what I'm suggesting is like the way most people talk about this is
Mm-hmm.
earn a bunch of earn a bunch of high active income
Mm-hmm.
first, and then downshift into something more passive.
Right. And that is true. That is something that, the hope. I can't remember exactly when I said. It's like, man, I can't wait to have so much money I could just be a lender. So yeah,
Yes.
that's what you're saying
And
here.
if our question is what's the least amount of so we're trying to get to 10 million.
Mm-hmm.
What's the least risky, least amount of effort way to do that? Well, you tell me. If you're exposing, flips can go wrong. I'm making an assumption that I'm going to get 70% every
Right.
single year, but that's not guaranteed,
Right.
right? So when I take less risk here on my first investment, yeah, it's not as much. We're only making 35 grand a year. But when you take that off the table and then you invest that at 70%,
Mm-hmm. Yeah, this
right?
is us talking about the golden goose before, right? Like, let's take care of the golden goose, have it spit out income, and then take that surplus income and invest that at a higher risk, higher return investment.
That's right.
Yeah, right.
That's right.
So we're talking about here is let's take less profit with our goose.
Yeah.
And then take the profits from the goose and invest that in a higher return scenario.
Exactly. The
Right.
order is wrong.
Yeah. And the
And it's
reason why we're
just
saying
math.
this is that if the flip goes wrong, we're only losing house money. But
Exactly.
the other way, if we're taking out our a loan or equity out of our home to invest in a flip, if that goes wrong, you're now exposing your primary residence.
Yes.
So
So if
the order is done in such a way where we're only investing with house money, money that if you lost it, it sucks, but it's not your hard-earned money. This is the money that we got to play with.
Yep, that's right. So it's just a matter of, if this is your reliable capital source, we want it to stay reliable. So
Mhm.
the goal here is to get this number as reliable as possible, but high enough that we can tolerate it. Now, let me show you how the numbers get really crazy here. Let's say you've got $500,000 in cash. You flipped for 2 or 3 years and I don't know, it doesn't really matter how you got to it. Let's just say you were able to come up with 500K in capital of cash, of your own cash. You're not paying any debt. And you can invest that at 12%. And then you turn around and you flip once a year and you need to get a 70% return on that capital. What does that do to the numbers? 17 million
Yeah.
after 10. And I know most people that flip that are getting closer to 100%.
Mhm.
Now you're at 61 million. There's a reason why there's massive wealth to be generated in real estate.
Right.
Now, am I suggesting that you could get 100% return or 70% return every single year for the next 10 years? Maybe, maybe not. But I guess what I'm advocating for is you can fiddle with these numbers here and you can figure out how to drive this to 10 million. And you're like, okay, well, I need 600,000. There you
Yeah,
go.
and I think
15 million.
that 10 million in 10 years, we're using this as an example. We don't know what your number is. I've written 25 million when I've done this exercise before, right? Because 25 million gives me 100,000 a month really easily,
Mhm.
right? Um, so don't just use uh, 10 million per se. Another thing too is it doesn't have to be 10 years. We had
Exactly.
Colton Fast on the Whale Club on Wednesday. I mean, he said like the cool thing was once he realized, and it's hard for us because we're all drivers, we want it all done now. Once he gave himself permission to take longer to hit his goals, he could make clearer, sounder decisions with less pressure.
Right. Yeah, the longer you give yourself, the more likely you are to get what you want.
Yeah. So we put 10 years here. But man, if you're 22, it could be 22, it could be 20 years,
Right.
25 years, right? I mean, even at 25 years, you're not even 50 yet. Ugh, disgusting. So,
Yeah.
I'm 43. 10 years sounds about right. I'll probably put it closer to 7 for myself personally. So everyone's situation is different. So the example we're using, 10 mil in 10 years, it really is dependent on you. Oh, also what you're starting with.
Yeah. Well, let me give you let's talk to the capital raisers in the room
Hmm.
because again, I'm not advocating anything. I'm suggesting here is this is something that could be done. And this is what math is. So, let's say that you know a lot of people that actually have money and you can borrow $1 million at 8% from someone else. And then you can turn around and invest that into a development project, for example. I mean, I pay total IRR close to around 15%. I mean, most syndicators out there are investing for a 18% IRR,
Hmm.
essentially.
I want to elaborate what that is.
It's an internal rate of return. It's an annualized return. So just think of it in terms of like I can get 15% every single year. IRR is just a way of saying like this is what it is per year.
Hmm.
So let's take this scenario. You borrow $1 million at 8%, and you turn around and you invest it with an operator at 15%. And then you do the same thing. You turn around and you take that money and you invest it into a flip. And it doesn't even need to go that great. It's just 50% of you just need to take 50% of your money every single year, actively investing it in some form of real estate. You're at 8 million.
Mm-hmm.
Okay, great. Let's fiddle with this number here. What if we raise 2 million? 15.8 million. There you go. So you're like, oh, okay. So what about 1.5 million? Let's call it 1.5 million. That'll
Yeah.
do it. Right. So we talk about solvable problems all the time, guys. This is what we mean. Do you know your numbers? Did you know that if you wanted to make $10 million dollars over the course of the next 10 years, it starts by one strategy you could do. You might say, hey, I already have someone who's willing to lend me $1.5 million at 8%. And I know somebody I can invest in it with 15%, highly reliably.
Mm-hmm.
Great. You can just take your money off the table each year and then go do one flip every single year. And
Yeah.
literally, if you just did that for 2 years, took the money that you earned in those first 2 years and then just flipped with that money, by the end of 10 years, you'd have 6.7 million. Again, if you borrowed that same million and a half, you didn't raise another dollar, you'd end up with close to $12 million by the end of the 10 years. And this was just so eye-opening for me because I was fighting so hard to build this big business
Mm-hmm.
when realistically, what are we talking about here? Can you raise $1.5 million? Yes, I can. I already have. I've raised almost 4 million.
Mm-hmm.
Let's plug this in. In the last year or so, we've raised almost $4 million. And most of this is being raised at about 12%. But I'm turning around and I'm investing it into my development projects where I'm earning about 33% on that. That's a little high. I guess it's more like 30. And then let's say I took that money off the table and I did one flip with it per year. That's $46 million just doing that 2 years, taking the money off and then putting that into, flip projects or development projects.
Yeah. So I
You
think
did
what's interesting, right? Just for everyone that's like following along here, the previous example, or so let's just say this current example, is you're just raising capital.
Yeah.
You're raising capital and you're doing a flip, right? That's it. In the previous example, you're borrowing against some of your assets and you're doing flips. There's no wholesaling here. There's no sourcing of capital here, right? Or no sourcing of properties here. There's no sourcing deals here. Or there's no, we're not accounting for spending money to source deals. So what we're talking
Right.
about here is if you're just a flipper, you only need to be patient and wait for one good flip a year,
Right.
right? You don't have to do deals. You don't have to do flips. If you're just patient and you just do one good flip per year, life is pretty good, right? It might feel, what's the word I'm looking for? You might have a lot of anxiety waiting for that next flip. You don't know when it's going to come. But
Yeah.
really just saying you only need one good flip a year. You don't need to spend money on data. You don't need to spend money on cold calling, a fancy CRM, um, PPC, direct mail, any of this stuff. And look, I'm not speaking against any of those things because that's what I do. I love finding deals, right? I love the hunt, right? What we're saying here is you don't need to hunt. You could just be the guy that flips. There are a lot of flippers that don't care for how much we wholesalers charge, right? But if you look at this here, if you're a good flipper, you have no overhead except for the flipping component. As a person that's sourcing deals, I'm spending tens of thousands of dollars every single month. And if I have a goose egg, that means Steve's writing a check to keep the company afloat,
Mhm.
right? So just bear in mind here. And I'm not saying that flippers don't have any overhead, but most of their overhead is wrapped into the actual flip.
Yeah. Yeah. I mean, I think, yeah, you nailed it. What we're trying to illustrate here is not necessarily that building a wholesaling business is wrong, not saying that flipping houses is right or developing or none of these. It has nothing to do with any of that. What it has to do with is our brains can't quite wrap our head around this math until you see it.
Hmm.
Again, we say, yeah, but yeah, I want to go actively start doing flips with this source of cash or this source of money from my HELOC or source of money from that I'm raising or something like that. But if you're starting out, I mean, you're taking on a lot of risks to do that. And again, what the brain melting math says is back here on this chart is if I can raise $4 million at 12% and I can partner with somebody. I mean, this is what I did with my development projects. I'm basically making a third of that deal and I raise the money and I'm paying the money off from my profit and I'm keeping the rest. And that's it. And we'll just do this once every year. That's it. I only need one good project a year. And it's also like I'm just taking the money and kind of mine's going to look a little different because I've sort of optimized for some different things. But I think this is my point is a lot of time we get the directionality wrong. We're
Hmm.
trying to invest it at too high of a percent. You know, maybe you're starting off with 250K and you can borrow this at prime plus one, which is what, like, let's say 9% right now. And then you could get 15% in a syndication. And then you could get 50% as a flip. You know, that's 1.699 million. Again, this is just you're just tinkering with math. Again, what you'll start realizing is the lower you can get this percentage, the better.
Hmm.
And this becomes an active participation in order to get 50%. But most people are making more than $22,000 a year actively investing. You know?
Yeah, and this is a an illustration of base case and chill.
Yes. It's an illustration of base case and chill. It's exactly right. And again, we made this mistake in other areas of our life, other investment opportunities and things like this. Let's not make the same mistake in real estate. Let's not make the mistake of not knowing the numbers,
Hmm.
right? If you don't know and you don't see this stuff, you'll default to, well, I have to grow this massive business. No, you don't. You don't have to do anything. There's not a right or wrong way to approach any of this. If you want to build a business because you want to be a leader, you want to impact people, like that's beside the point. The point is all I'm advocating is make decisions off of what the numbers actually say,
Hmm.
you know? Because you and I would much prefer to just make decisions based on our impulses and like what we would rather do. But
Yeah.
again, when you look at it and you realize, actually, I don't need to be working nearly as hard as I need to do, or as I am right now. The goal is for me, how do I raise enough capital at a percentage, place it at a higher percentage, take the top, take the excess, you know, the house money, thank you, pay back the lender, and then go gamble with that money. Go gamble with house money and place that on things. And if you do that successfully long
Right.
enough, you're talking about not just like a couple $1,000,000. We could be talking about dozens of millions of dollars in these cases, and that's the brain melting math.
Yeah, no, it's pretty insane. Um, could we share a link to this tab on our YouTube channel in the descriptions?
So people can have it?
Yeah,
No.
that's too bad.
You can get it by scheduling a certainty talks or what do you call that? A certainty strategy session with me.
Yeah.
Right. This is a tool that we only use for Whale Club.
Hmm.
That my members, you know, get in the business treasury series, and we help people kind of walk through this and evaluate it. However, I am willing to do this on a certainty strategy session for people. I'm not just going to send people the spreadsheet because, you know, it can, how do I say this? It's almost like it doesn't make a lot of sense if you don't have clarity on what you actually want
Hmm.
first. Bigger numbers don't always mean the right thing. And I think that can be confusing for people. They're like, well, why wouldn't I just, if I did this, I could make $80 million as opposed to $50 million. It's like, but you just told me you only needed 10.
Yeah.
So why are we taking on more risks to optimize for that?
So what we're talking about here is you can walk them through this together and understand what their reliable capital source is, what their APR is, what their options are for investment number one, investment number two, and also figuring out, uh, talk them through what their target number is, and then we can show them here's how you do it.
Sure. I mean, that's exactly right. It's really, I look at this as I will help you do three things: figure out where you are, figure out where you're trying to get to, and figure out what it would take, what a machine might look like,
Hmm.
the ranges of things that you could go and pursue. Because if you only need between 10 and 20%, that's a different type of investment profile than if you needed 50 to 70%.
Yeah.
If you needed over 100% every single year, I'd say probably need to lengthen your timeline or figure out how to get access to more capital, right? And this is all really informative as we start building our business and our investments. And I do say this all the time. There's a big difference between a real estate investor and a real estate entrepreneur. Two different things, right? You don't have to, subscribe to this one size fits all. You have to build it this way just because somebody else is doing it. That's just not true. What we talk about in rigging the game is, in order to rig the game, you got to know what you want. You got to know what success actually looks like. And then we help you design it based on your unique strengths and preferences and your own definition of success. And that's what we've been trying to do here for the last couple of years. And
Hmm.
yeah, we're getting closer. And it's
Yeah.
using tools like this, by understanding the actual numbers, that help us make better decisions in business.
Right. No, it's definitely true. I mean, just the clarity I've had in just the last month and a half, and how I'm, running my business, and I'm really excited because we got our quarterly for our wholesale company is going to be on the 15th, so in 8 days, and then the quarterly for the other two companies on the following Monday and Tuesday. And now that we're having different questions going into the meetings, we're going to have better answers or better outputs
Right.
from those meetings.
Yeah, and again, you've been talking about the minimums, minimum profit and
Hmm.
stuff like this. And again, I'm going to come back to this equation here, or
Hmm.
this spreadsheet here. It's like, if you know that your minimum profit target is, we need to be able to earn 70% on the money that we're investing
Hmm.
into the active projects. The active side of the business needs to generate 70% in order for you to hit your goals.
Yeah.
You just figured out your minimum profit target.
Yeah. In you and I, we had a conversation, not on this show, but somewhere else, um, on the call we had with Jason Lewis. And yeah, we're going to change it. It's going to be what are our non-negotiables moving forward? What are our non-negotiables?
Mhm. It's great if you make more than 70%.
Yeah.
I'll take it. That's part of collapsing time. We're going to get there a little faster, or we use that to take less risk. If you double your money in 1 year, maybe you don't have to do a flip the next year. You just take the year off.
Right.
Good on you. So we'll take more. We don't want less, because the whole point of the solvable problem is, are we on track to fund the things that we want? And that's why I think you're on the right track there. Talking about minimums, like, what do we absolutely have to have in order for it uh, to justify continue running this business?
Yeah, and that's key to justify running it. Yeah, I mean, I've had a lot of people ask me some difficult questions, right? Like, why are you doing this? Why are you doing that? It's like, these are the non-negotiables. These have to happen. This makes everything else. This is the economic engine that makes everything else go.
Hmm.
So yeah, the non-negotiables. They're like, this must happen. This must happen, or heads are gonna start rolling.
Right.
Right.
Yeah. Well, so, and again, I just want to make sure I'm clearly stating all this. Excuse me. I'm not suggesting that if you invest your money at 12% with a private lender, that there's no risk to that.
Hmm.
I'm also not suggesting that you can get 70% every single year for 10 years actively investing. I'm not saying that's not doable either, right? It's just, this is what the math shows. If
Yeah,
you
none of
understand
the
your
numbers you're
numbers,
sharing are unreasonable.
right? So think about that as you're trying to design your machine. I mean, of course, you can spend time with me. I'll walk you through this spreadsheet. You guys probably saw it enough if you want to make it on your own. I'm not going to send this out because this is something we only do for whales. But like I said, I'm happy to just walk you through it and give you some direction, so that as you're, starting your career, or you're 3 years, 5 years, 7 years in, and you're saying, man, I'd really like to not have to work so hard to get where I'm going, right? I don't want to keep chasing more and more and more. Well, let's look at the numbers and understand, what do you actually need to hit your goals? Because it might be a lot less than you realize, and
Yeah.
you might be a lot closer than you think. But because you just keep moving the goalpost further and further back, you never seem to get closer and closer to what you're going, or what you're trying to do. So again, that's what we sort of help people do. And if you'd like to do that, you can go to realestatecertainty.com. And right there on the homepage, there's a little button that says book a strategy session. You can book that with me. It's a 45-minute call, and I'll go through this with you. Again, just to remind you guys, this is a better episode to watch than it is to listen, because we are talking about a lot of math, and it's just there's only so much you can talk about where it makes sense. So go to YouTube and go to Paul Sparks Official. That's my YouTube channel. We've got all the Certainty Talk podcasts on there now. Again, we had to pull it off of the Real Estate Disruptors podcast because you got a bunch of hooligans on Pardon the Disruption
Oh, wait a minute
talking
there.
about. I love all those guys. You got Pardon the Disruption. You've got a podcast interview. We've got Certainty Talks, and it was throwing off the YouTube algorithm. So it's all in the same place on the Disruptors podcast app. So on the app there, but we just had to pull it off YouTube. So if you want to watch this live, again, go to Paul Sparks Official, and you can find it there under the Certainty Talks podcast, channel.
Perfect. Awesome. All right. So again, the goal here was to melt your brains. Hopefully we accomplished that. And then we will see you guys next week. Bye, everyone.